Joining us today, and shout out to our sponsors, CP Group and Roberts Commercial Flooring. We got Juan over here representing Roberts Commercial Flooring, and they're able to make this possible today. Welcome to Build Up Network's Spark Series. We aim to deepen connections through Atlanta's commercial real estate space, balancing both technical and soft skill presentations. We hope you walk away today with a new perspective and some new connections. This is intended to be a pretty casual conversation, so feel free to interject, make some adds, or challenge David if you disagree at any point. We can make this interesting. Today we have David Kaplan from Stonmont Financial to discuss the basics of cash flow. If you could please join me and give him a warm welcome to the stage.
Cool.
Thank you.
Thank you, Austin. Thanks everybody for joining. Excited about the Build Up Network, and thanks to CP Group and Roberts Commercial Flooring for sponsoring the event. Like Austin said, this should be pretty casual. I think about things in a very academic way, and so the room and space are fitting, but please just shout out if you have a question or want to add something to the conversation. So like Austin said, I work at Stonmont Financial Group. My role is asset manager, so that's leasing, operating, selling, refinancing our portfolio, which is primarily Class A industrial space. In prior roles, I've worked in an acquisitions capacity, in other asset management capacities. So trying to think about this real estate finance beyond just the finance, but more so as real estate investing, because that's what I think everybody in this world is really doing. So I thought it'd be helpful to just define a couple terms. I think everybody in this room understands that commercial real estate means income producing. So the primary goal of anybody investing in commercial real estate is to earn a return on that investment through the rent generated at the property. And to further define commercial real estate, that's industrial properties, retail properties, multifamily, office, and a large umbrella beyond that. And then more technical, underwriting is the data-driven, comprehensive process that investors use to evaluate the risk, financial viability, and value of a property before making an investment. You'll hear me use the word underwriting throughout this presentation. And the format of this is really to give everybody context, and then at the end we're going to go through a case study where we work through a real estate investment opportunity, because I thought that was the best way to drive the point home and push people to think about what we're talking about.
We get a certificate.
That's right, you do get a certificate at the end of this. So thought it would also be helpful to describe the scale of commercial real estate in the United States. So these traditional property sectors that we just went through account for almost $16 trillion worth of value. 11.4 of that is institutional quality. I think that's what most of us in this room are working with on a day-to-day basis. Commercial real estate accounts for roughly 20% of US fixed assets in total. These activities account for 10% of US GDP and employ 13 to 15 million people. So this is massive. In the spirit of this 90s style presentation, I thought it'd be good to add some clip art. Hopefully everyone appreciates that, because there aren't too many pictures in this presentation. But why do people invest in commercial real estate? So the first, I think, broad strategy is diversification. This is adding a piece to the overall portfolio, which includes equities, debt, and other types of investments. It is a tangible asset class. I think a lot of people hear that when we hear about commercial real estate, because it offers more security compared to stocks or bonds, which you don't own dirt if the investment doesn't go as expected. They offer consistent cash flow because a lot of long-term leases with businesses create stable, reliable income streams. There is asset appreciation. Investors benefit from long-term increases in property value. And then two, I think, lower down items are inflation hedge. We see prices in commercial real estate move along with or in advance of inflation. And then tax advantages, which are pretty technical and I don't even know enough to talk about. So we'll just pass on tax advantages, but really the goal is to diversify your portfolio, generate a return through consistent cash flow and asset appreciation. So who are the types of groups that invest in commercial real estate? And before we dive in, I think it's important to remember that all of them are, again, trying to earn a return, and many of them have different strategies. Your institutional investors are large organizations that invest pooled capital on behalf of other individuals or groups. And these include pension funds, insurance companies, endowments, commercial banks, and private equity. And we've listed a couple examples here. Your pension funds are utilizing retirement funds to seek long-term stable cash flow. Your insurance companies are investing a similar way into high-quality income-producing assets. Your endowments are managing generally donations from nonprofits like universities or hospitals. And then commercial banks can make direct investments or investments on their clients' behalf. And then in the private world, you have high net worth individuals and family offices who are usually investing on the smaller scale. And then publicly traded entities, so these are REITs that own and operate property and allow individuals like us to buy shares on the public market. So the simplest difference between commercial real estate investment strategies, in my opinion, please correct me if you, or add something if you think differently, but it is an equity investment and a debt investment. So your equity investors have a higher risk tolerance and they have unlimited upside, but they also own the entire downside of the investment. And these investors usually sit higher on the capital stack. And we'll think back to this capital stack as we work through the case study later on. Your debt investors are lower on the capital stack, they have lower risk, but they have limited upside. So they're not going to make any more money generally than their interest rate on their loan. But their downside is protected because if value falls below that 100% of the initial value, they're still in the money up to that 60% of the original value.
Can I ask a stupid question?
Sure.
So when I think of equity versus debt, the debt I look at is like a lender.
Yes.
Is that the proper?
That is the proper way to look at it. Those terms are interchangeable.
Okay.
But we do think
like the rich guys like Matt.
we do think about lenders making equity investments, and I'm going to unpack both of these a little bit more on the next few slides, and kind of go into why we consider debt investors. But we're really going to focus this presentation from an equity investment lens. So your equity investors, mentioned this a moment ago, unlimited upside. So the better investment does, the more money they make. And even within the equity group, there are different pieces and groups doing different things. Most of your institutional type equity structures include a general partner and a limited partner. Your general partner is contributing fewer dollars into the deal, but they're responsible for operating, underwriting, overall strategy, and they hold a lot of the liability. Your limited partners are your passive equity investors in these deals. And the general partners generally structure these so that there's outsized return if a deal outperforms. And then within the equity investment strategies, you have core investors who prefer lower risk, stabilized Class A properties in good locations with predictable cash flows. You have your value add investors who seek properties that need moderate improvements or better management just to increase your net operating income. And then you have your opportunistic or speculative investors who target high-risk projects such as ground-up development, which I think a lot of people are familiar with, or distressed assets, aiming for significant capital appreciation. And then to touch on debt here, I think it's important to identify why equity investors actually go out and get a loan or get debt on their properties. And so debt helps magnify your returns on equity. When you put down fewer dollars and you maintain all of the upside, that upside funnels into the equity bucket and provides for an outsized return on a lower investment. This is something we'll look back on in the case study, and I think it'll make more sense once we get there. Portfolio scaling and diversification. If you're able, as an equity investor, to put fewer dollars into a deal, you can go out and do more deals, and you can diversify beyond that single property. And then positive leverage. This is pretty technical. Again, you'll see this when we get to the case study, but if the cap rate on a property is higher than the cost of debt, the investor earns a higher yield on their invested equity. That's maybe a little out of order here. Next tab, we'll define cap rate, because I think that's a fundamental concept for investing in commercial real estate. Whenever I talk to students, for the most part, about what they need to know going into the industry and getting into real estate finance, I say you need to be able to value property. And so the simplest way to value property is using a cap rate. How many people have heard the term cap rate?
I heard about it yesterday. My dad asked me, he's like, what is cap rate? And I was like, let me Google it.
There you go. So simply put, your cap rate is your net operating income divided by your purchase price. And it represents your year one return. So in this case study that we're about to look at, we're presenting $1.3 million worth of net operating income on a $24 million purchase price, and that results in an approximately 5.75 cap rate or year one return. This does not represent the ongoing annual return to equity investors, as things can change throughout a deal. So you have your rent increases, your expense increases, you could lose a tenant, you could have a capital item, or your debt can impact that return to equity. So this is a metric that is used by both debt and equity investors on the valuation side.
Do you have like a cap rate for different markets?
So this cap rates are generally determined by an investor's appetite for risk and the market's overall appetite for risk on a specific asset class in a specific market.
And this is like a study speculating on rates around Dubai,
It's-
how much the construction would cost?
That's right. It's generally determined by many market participants transacting over large periods of time. So as there is more risk in the office sector, investors will demand a higher return on their investment. And your cap rates are going to be higher on office investments. Similarly, or I guess conversely, in the industrial sector, there is strong investor demand, and you've seen investors willing to accept a lower year one return on that type of investment. And so you can see how cap rates move in different markets just by looking at recent transactions in these markets. And so 5.75 is consistent with what we see on Class A industrial projects in strong markets. So this is actually representative of what an investor would be interested in buying an industrial property at.
Is that based off of speculation on how that first year will do? Or are you entirely relying upon the financial information given to you by the seller?
So you're not guaranteed that return. It is more of a moment in time type metric. And I think that we're about to get into the case study, so hopefully that answers your question. No. It's, as I was putting this presentation together, I was torn between laying the case study in with this type of content, but I think as we go through this, maybe we can revisit some of these concepts if that's helpful. And beyond cap rate, investors are going to look to different return metrics to understand how much money they're going to make on the deal. The internal rate of return is usually the metric that people are talking about, but you can think about this simply as there are other metrics that we'll talk about later on, I think. But it's also important to understand that investors are determining their purchase price or their budget based on what they think the investment is going to make over the life of the investment. So, and they will check that purchase price by looking at the market cap rate. But it's also a market where there are other participants trying to buy the same deal you are. So there is competition in that as well. So gonna work through this case study here. This is awesome Class A building that Stonemont just delivered in Tampa. This property is actually vacant today, but for this presentation, I'm just gonna assume that we've got 110,000 square feet that is 100% leased to 5 different tenants. I think we're back now. All right. So what we're going to try and do is underwrite this real estate investment. We have 5 tenants on this rent roll. As I said, it's 100% leased. And I've highlighted a couple columns that we're going to think about as we work through our business plan on this investment. And so we want to think about who is in the building, what are they paying for rent, and how are these leases structured. So we've got 5 different tenants ranging from 11,000 to 40,000 square feet. They're paying different rents on a per square foot basis, and they have different lease expirations. There's a lot on here, but this is how we think about the character and nature of a real estate investment. One thing I'd also like to point out is there's a column here that says recovery structure, and you'll see all of these are written as triple net, as we call them in the market. That means that your tenant is reimbursing you for all of the property level operating expenses, which is the simplest format and standard in industrial leases and retail leases, but uncommon in office leases. So this allows us to think pretty simply about the cash flow. And another thing I want to call out here is the base rent. We said that these tenants are paying different rents on a per square foot basis, and then the column right next to those rents is the market rent. So we think many of these tenants are paying under market rent. And so our business plan here is to increase these rates when these tenants expire, and then sell once we're able to do that. The risk here is some of these tenants may vacate, some of these tenants may not sign at the rates we want. It might be more expensive to do the deals that we want to do. And so we've got a rollover schedule here that identifies when this turnover occurs, so we can think about how long we need to hold this investment. So just looking at the last lease expiration on our chart, May 2029, looks like we need to get at least through the next 3.5 years before we can think about selling this.
I'm gonna ask another stupid question. Why do you have to wait until the tenant's lease is up before you decide to sell?
You don't. We just think we can maximize value by getting through these lease expirations so that we have the opportunity to convert these below market rents to a market rent. So the goal is to increase the rent that the property generates.
So you want renewals?
Exactly.
Okay.
We want to get through their lease expiration. And then I've also highlighted their steps, which are the annual escalations in these leases. So your T3, for example, or T2, those are our 2 biggest tenants at the property. Every year their rent increases by 3.5%. What we're seeing in this market is that rent's increasing by 4% per year. And so there's some opportunity for us to further increase value outside of just marking these tenants to market rents. I've got a simple income statement here just to drive home the triple net structure. You'll see that our rent roll shows $1.3 million of base rent per year. You'll see that appear on the top line under potential base rent. And then OpEx recoveries, that's the additional rent that each one of these tenants is paying us for their share of operating expenses. You have your standard operating expenses below that, taxes, insurance, your management fee, and your common area maintenance. And at the bottom, you have your net operating income. So that is the metric that we're using to value this investment. And you'll see that since this is a perfect triple net property, which is not always how it works, your net operating income ties directly to your base rent, which is as simple as it gets. And it, like I said, doesn't always play out like that. And so for us to think about how much money we're willing to pay for this investment, we need to think about how much we think it is going to generate in terms of a return over our projected hold period. And so what I've layered in here is assumptions behind the scenes about what we think tenants are going to do over this hold period. If you guys remember, we were looking at $1.3 million of income in place, but we had one tenant who was on a month-to-month basis. So that MTM, that means that they can vacate at any time. And ideally, as an investor, you want to have long-term tenants who are stable and contributing recurring rent. So our first order of business is to get that tenant either out or on a long-term lease. For this analysis, we've assumed that your T3 and T5, the month-to-month tenant and the other one with a near-term lease expiration, vacate. And we have 6 months of downtime. So your base rent at the very top drops from $1.3 million to $1 million in year 1. But by year 2, we've backfilled those spaces. And then by year 3, you see that rent continuing to go up. That's us marking some of these tenants to market. And when the property has higher vacancy, we're recovering fewer operating expenses. So a loss of a tenant isn't just a loss of base rent, it's more impactful to your net operating income. And so this gets us through year 4, where we're looking at when we complete our business plan in May 2029, telling our future investors or our buyers that the property is generating $1.49 million worth of NOI. So we bought this with 1.32 in place, and we've driven NOI 13% since we acquired it. And there's our simple exit calculation. So I said we were buying this at a 5.75. And what we're saying here is that an investor is actually willing to accept a lower return for this investment. And our thesis is that we've made this a better investment because we now have long-term leases with rents that are more consistent to market. And we were paying a higher cap rate and requiring a higher year 1 rate of return because of the risk with that month-to-month tenant and some of these other tenants that are below market and have rolled during our hold period. Below net operating income, you'll see tenant improvements, leasing commissions, and capital expenditures. TI and LC are just costs of doing leasing. If you sign a new tenant, you need to change their space. You need to pay the brokers who are involved, and that is more expensive than retaining an existing tenant. If you retain an existing tenant, you might have to contribute a few more dollars of tenant improvements, and you'll likely pay their representatives in that renewal transaction. And so we get all the way down to the bottom with our unlevered net cash flow. That includes our purchase price, our closing costs, and then our sale price and our sales costs as well. And so I've laid out 3 different return metrics that equity investors typically look to when they're thinking about making these investments. So that's the IRR, which, yeah.
So you were talking about your internal decision, your cap rate, you guys were comfortable with was 5.75, right? And that was internally for your company deciding to purchase the building.
That is me in this case study.
In the case study, right?
But yes,
Sorry, yes, correct.
this is totally made up.
Correct, in the case study scenario.
Yeah.
And then you're basically presenting the information to sell it at a lower cap rate, saying like there's a potential for lower return on this based on these numbers, right?
Yeah, I'm saying that we've added value to this investment by cleaning up the rent roll in a way that the next investor is willing to accept a lower rate of return than we were when we bought this.
Just more stable. Less
And
risk.
my investment committee might yell at me. It's been a few years since I did acquisitions. I think most groups are thinking cap rates are not compressing over a hold period because you have an aging asset. But the point I'm trying to drive across is the value add here from our standpoint is improving the rent roll. And since equity investors are trying to generate stable, consistent returns, we've now repositioned this asset to do that for those types of investors.
And you say a 5-year hold period is pretty.
So I've got a 3-year hold period here. It depends on investment strategies. You'll see your insurance companies and pension funds and some of your other institutional investors look to buy Class A trophy assets with longer term leases and hold likely for 10 years. But you've got other groups who are looking, in the private equity world, which is where I work, that are trying to add value in a short amount of time, 3 to 5 years, and realize a return over that period of time. And so now we'll get into the sources and uses. This is when our debt comes into play. So, and we'll compare equity, the unlevered analysis versus the levered analysis in a sec. So using the 60-40 contributions that we looked at on the original capital stack, we assume that our lender is going to fund 60% of our initial costs and they'll also contribute 60% of our leasing costs. So we're saying that the total investment is close to $24.7 million, but our equity contribution in this investment is actually limited to $9.9 million. And this is a very simple representation. Debt is structured differently on every deal. We've assumed 60% of initial and future funding. We're using a 6% interest rate, and we're assuming that it's interest only. So sometimes these loans amortize like they do on our homes. But by structuring as interest only, which a lot of equity investors like, you have a lower monthly interest payment, and that allows more free cash flow or net cash flow to the equity position. And here's our impact of debt on this investment. So you have your unlevered cash flows at the top. That's what we just talked through. You have your loan funding, which is 60% of your total proceeds. You have financing costs associated with that loan. This loan funding between year 1 and 3, that's your future funding to fund your leasing costs, and then your debt service. So what we see here is on your unlevered cash flow, you're seeing positive cash flow every single year. In your levered cash flow, you end up with negative cash flow in that year 1, but you have to put down far fewer dollars at time 0. And so just, I think to recap and try to pull this all together, I want to refer to the unlevered versus levered return summary. So look first to the bottom line that says peak equity. So in an unlevered scenario where we don't have debt, your equity investor is contributing $22.5 million to close this deal, or to get to do this investment. However, when you introduce debt, you only have to put down $8.7 million. So that allows you to diversify your portfolio, expand the scale of your operation, and it inflates your returns. So we bought this for a 5.75 cap, and we were able to, with the help of debt, increase our unlevered return. Instead of making $9.2 million on $22.5 million, we're making 15% on $8.7 million. And the other two metrics here are your whole dollar profit. So this is simply the sum of your cash flows. So in your leverage scenario, you're making $4.5 million on 8.7 versus $6.7 million on 22.5. So just to drive the point home, leverage is very helpful for your equity investments, but can also move in the other direction if your investment isn't performing. So that's part of the risk that the equity investor is taking on when they come in. And then to answer your question here, we've got this matrix on the left that compare your income in place, your year 1 net operating income, and your stabilized net operating income, and the resulting cap rate or yield. So the seller's telling us that we're buying this for a 5.73. In year 1, we saw NOI dip. So our actual year 1 yield was only 4.25. But as we continue to clean up this rent roll, we get our yield up to 6.06%. And if you're selling the property at a cap rate below your stabilized yield, there's implied profit in the deal. So a lot of us in this industry are thinking about our stabilized yield on cost. I know there's a lot in there. I'm sure there's a ton to discuss. I did my best to squeeze a ton of content into 20 minutes here, so maybe we can talk about this. Yeah, let's do that.
Can you break down loan funding and debt service in year 1 and year 2?
Sure. So your
Just like the additional.
Yeah. Sure. So your initial funding is, so we close the deal, you get $14 million.
Right.
We have 2 tenants leave, and then we find 2 new tenants, and that costs, we see $460,000 in TI, another $172,000 in leasing commission, so we have $570,000 worth of leasing costs.
Yeah. Are you collecting additional money from the lender in that scenario?
That's exactly right. So they're in this case study, they're going to fund 60% of that cost. And so that future funding is helping us with that burden. And then the debt service is, since it's interest only, just simply 6% on the total outstanding loan proceeds, which is 14.1 plus 380.
Can you go back one slide?
Yeah.
The equity, future equity payment of
So, yeah.
right, of 430, is that the same thing, you're collecting additional money from your equity partners?
So this is probably not doing this case study justice. That 430 actually comes from property cash flow, a combination of property cash flow, and that $148,000 that you see there.
Got it.
So in some way, the equity needs to account for whatever the lender is not providing. And if you have a cash flowing property, that's great. You can fund with cash flow from the investment.
Got
Neil, what else?
My next
I-
question is gonna be stupid, 'cause I wanna.
No, I know there's a lot in here. I don't know how many people, are familiar with these concepts or this equity investing world, so
So wait, okay, I'm gonna ask this stupid question.
please.
If the equity folks have to put in 40% of the TI money for a new tenant.
Yes.
It is a stupid question, I'm saying it up front. Is the 60% already baked into the loan? Meaning, they're not just loaning 14.1? There's a cap on the loan that's higher than 14.1, so that they know there's gonna be TI money and brokerage fees and so forth. The lender knows that up front.
It's a really good question. So we think of real estate investing as storytelling almost. And it's important for all of the capital partners, including our lender, to understand the story we're telling. And so when we put together this business plan, we're gonna tell that story not just to our equity investors, but to our lender as well. And make sure they know, based on our numbers, that we think we need another $1 million to stabilize this asset. And we have a negotiation with them. Are you guys willing to contribute to this?
But that's up front.
No, it's a future funding mechanism. So, and that is how a lot of transitional loans or construction loans are made. So there's no money up front in a construction loan.
So that way, you're saying like, when you have that one tenant that's gonna, 1 year out, they're about to go, you're already projecting like, hey, it's gonna be at about $1 million to stabilize that.
A lender's not gonna fund, yeah, we'll
In a year
say
from now,
what-
we're gonna say like,
we'll say what we think it's gonna be.
yeah, we'll say in a year, so that way when 2020 happened and everything, all the material costs went up and all those projections that everybody did the year before just completely collapsed everything that was,
Yeah, I think,
Yeah.
so a lender's not gonna fund unless we sign a lease. We'll tell them what we think those leases are gonna cost. And if they end up costing more, that's a conversation between us and the lender. Hopefully we can convince them that these are dollars they should be giving to us to fund this leasing. But the story we're telling to the lender is, this is what we think, this is how much money we need from you guys, and that will provide shared success for all of us.
I think it goes back to Jason's presentation when he was talking about,
The chain.
they don't fear risk, they fear surprises.
That's right.
Yeah.
We're gonna lend a certain amount up to the performer, right? And so, to your point, you're on the lease, we're gonna look at that lease, here's how much we're not gonna contribute. And then, you're not contributing that 40 or 35% of your equity on the front. And then we'll do the remaining equity.
And in some cases, lenders aren't going to fund future leasing costs, and that'll just be an equity responsibility either from net cash flow at the property or from additional equity from your investors. Every deal is structured differently. This is, I think, a pretty good example of a vanilla industrial acquisition. And what I tried to do also was use return metrics that I think our investors would be happy with. If I presented this to our committee and they believed my 5.5% exit cap, I think that they would approve of this investment. The reality is, I think the market would drive up price to a point where we wouldn't want to compete, because it feels like there are a lot of investors interested in Class A industrial and willing to accept a lower rate of return than we are. So that is part of the game as well. I can talk
In
a
the
lot
case study.
about a lot of different things here.
Another question.
Yeah.
So you're Stonemont, you said you're not on the acquisition side anymore, so are you doing something different now? Like, you're focused in industrial, is that right?
So I'm on the asset management side.
Okay.
So I'm the one negotiating leases, signing leases, operating the assets, and then selling them once we stabilize the business plan.
Yeah, I know this is not maybe as much your world anymore, but from a state of the market in industrial, acquiring versus development, like, I think there was a lot of it over the past couple of years, and now there's a lot less due to
Sure.
construction costs and a lot of reasons. Anything that, like, you can say about that, not that
Yeah.
it's spot with the crystal ball, but like the future for it?
Well, development slowed significantly when interest rates went up. It was very challenging to capitalize a deal. We saw a lot of the bulk users, Amazon, your Fortune 10 companies, not needing the type of space that they needed in 2020 to 2022. And with that demand fall off on the bulk side, combined with interest rate increases, it was very challenging for all developers to capitalize new deals, because to get a development underway, you need to find a limited partner on the equity side, and you need to find a lender who believes in your business plan. And so those two checkboxes were challenging in that environment. A lot of investors moved to existing asset acquisition. There is far less risk when you're buying a property that already exists. In development, you have cost risk on the development side, you have timing risk on the development side, in addition to your actual business plan, which is leasing up the asset. When you buy an existing property, the first two risks are already accounted for. It's already built, it's already delivered. So there was a big shift into acquisitions. Our shop pivoted to smaller bay infill type development where we could capitalize it. So this picture is a good example of something we delivered last year that better meets the market in today's supply-demand landscape, with local infill tenants always needing space and limited supply, certainly within the Class A space.
And would you say that's your kind of projection of the next few years?
We've seen a lot of bulk activity this year. Amazon was one of the biggest lessees of space in 2025. Our shop did one lease with them. We sold a building to them earlier this year. So we're seeing our larger users come back, and for the most part, they're eating into the supply that existed from the COVID wave of development. We are seeing new bulk deals getting capitalized and getting done, but it feels like a lot of the market's moving into the acquisition activity and really thoughtful, smaller bay infill format developments.
Thank you.
Sure.
Cool. All right, guys. Thank you,
You're
David.
tired of hearing from me?
No, that was great.
Thank you for having me, everyone.
Well, thank you for coming. Thank you guys for coming. We are hosting a conversation on the second Tuesday of every month. Next month will be electrical utilities, and CoStar will be hosting. So we'll have a similar presentation area. And Joe Cathy was up here a little bit ago. He had to leave early, but he will be presenting on that topic, and we look forward to see you guys at another event. Thank you.